Good afternoon, I'm Dan Choden with Trout CPA, and today we will be reviewing what you need to know when applying for PPP Loan Forgiveness. We're doing this video now because the Small Business Administration has finally opened their portal to accept forgiveness applications from banks, and some banks are already starting that process of accepting applications as well. We expect more will be joining in the coming days, as some are using different rollout strategies or even accepting applications in phases. So if you haven't been contacted already, you can expect your bank should be reaching out to you about forgiveness soon. Another reason we want to do this now is we think the rules have finally solidified into what we're actually filing with, partially because you can actually file a forgiveness application now, but also because long expected frequently asked questions have finally been published. And so those rules are out there. We're not really expecting those to change or the applications to change at this point. So perhaps you're in a stage where you've been very up to speed with the latest guidance. Perhaps you just need a refresher and haven't really given this much thought over the summer. Or perhaps you haven't even looked at forgiveness at all and you've just been waiting for the dust to settle on this whole thing before taking a deep dive. In any case, I hope this is a good summary video for you and can be really comprehensive of some of the guidance that you may need, some of the strategies that may be helpful, and take some of the pain out of this PPP forgiveness process, I hope. So today we're going to cover a couple of different areas. First, we'll look at maybe some strategies for waiting to apply for forgiveness and some benefits there. Taking some of the pain out of the process by perhaps using the EZ form. We'll review what the qualifying costs are and some of the updates in those areas and clarifications that have happened. We'll talk again about the reductions. That's really the biggest headache at this point is probably the reductions. Spending the money over 24 weeks is not as difficult as just making sure that we avoid any reductions in most cases. We'll also quickly review how we can help here as a firm, some other potential relief that may be coming, and look at our tools and how we fill out these forms and what that might look like for you. First, let's dive into why we might want to wait. So if the SBA is accepting and the bank is open, shouldn't we just file now and get it over with? There's certainly a desire to do that, and I can understand just wanting to put this whole thing behind you. But before we do that, you might want to understand that there's not very much benefit otherwise to just getting it done. There may be some additional benefits to waiting. So a few things to consider here. The first is that we don't really have an impending deadline. A borrower can file for loan forgiveness for 10 months after the end of their 24-week covered period. So for most borrowers that got their money sometime in April, this would put their covered period ending in September, and then looking at forgiveness applications being filed as late as next summer, even a year from now. So certainly nothing as far as a deadline is going to hold you back in that case. Another reason that waiting might be useful would be to just accumulate more costs. If you can use your entire 24-week covered period instead of filing with 8 weeks or some interim amount of weeks, that was going to allow for an awful lot more expenses if we just let more accumulate. And if more expenses are applied for with a loan, that can be a cure for a lot of these FTE or rate of pay reduction issues that we're going to talk about a little bit more later. So it can work as a really good buffer so that if there is something that the bank interprets differently or the SBA sees in a different way, we have a big buffer, a big margin of error, and we can still sleep well at night that our loan will still be fully forgiven, even if some of those minute details aren't all looked at the same way. Another reason you may want to wait is that timing of this may affect a taxability issue. And this is something that is a big unknown at this stage. There's even a big push to make sure that we can deduct all the expenses related to PPP loans. But as it stands today, there may be an argument that taxability or non-deductibility of those expenses would be pushed out to a future period if a forgiveness decision happens in your next fiscal year and not this year. So something that we're monitoring and wanting to be aware of may not turn out to be anything, but is just another reason that you might benefit from doing a forgiveness application later and not rushing to do it today. Lastly, there's also potential for future legislation that could significantly make this process easier. Now, this is a big if. In the current environment, getting a congressional bill to pass may or may not be something that realistically happens, but the temperature today could be different tomorrow, could be different next week. Anything is possible, and there's certainly been some positive PPP proposals out there that many hoped would be passed into law by this point. The biggest one you may have heard of was all loans under $150,000 might be forgiven automatically, which would be a tremendous help, as that's somewhere between 80 and 90% of all the loans that were issued were under that cap. So all the smallest loan borrowers wouldn't have to go through all this compliance headache. And that'd be a huge help for our clients, for banks as well. Another big proposal that was out there was that no supporting documentation would have to be submitted with applications all the way up to $2 million loans, which would be another huge headache just eliminated for borrowers that are going through this process. So again, that's always the potential that this could get simpler. No guarantees there, but you only could gain that potentially from waiting. The next thing I wanted to talk about simplifying the process for many borrowers is using the easy forgiveness form instead of the full application. The easy form is, as you would expect, much more simple and short. We just have a few lines here, 8 lines compared with the full 11 lines of the main calculation and the full forgiveness form. And not only that, the full forgiveness form, you also have PPP Schedule A to fill out and the Schedule A worksheet, and the complexity goes on from there. So if we can, of course, just be filing a simple 8-line easy form and avoid the extra headache, we're going to save some time. We're going to save some brain cells. So why and in what situations can we use this easy form? So there's 3 of them here. We'll go through them again. First is a very simple one. If you're a sole proprietor with no employees, you can check that first checkbox on the easy instructions checklist here, and you can say, that's me. You can use the easy form, and that's about as automatic of loan forgiveness as you can get, is just being a sole proprietor with no employees, filing the easy form. Very, very simple situation. The second situation you can be in is if you're a borrower that did not cut anyone's rate of pay more than 25%, and the borrower did not reduce the number of employees or average hours since January 1st. So this one's pretty narrow, but I'm sure it does apply to some, where for whatever reason our workforce wasn't impacted this year. We had the same 5 people, the same working hours the whole time, and where our workforce was intact and didn't change this whole time. Well, that's easy. We can certify to this then, and we can move on. The third one is a little more convoluted, and is probably the one that most of our clients are going to be able to fit into. And it uses the first qualifier is the same one. The borrower did not cut anyone's rate of pay more than 25%. But the second qualifier is a little more confusing. And the borrower was unable to operate at the same level during the covered period as they were prior due to official COVID-19 guidance. And that's just my summary. The full detail of that from the application is below. And it really references guidance as from these 3 federal agencies, Health and Human Services, Centers for Disease Control and Prevention, and OSHA as well. So this was a nebulous one, and the last time we did a video, we really didn't know how this would be interpreted, how broad it would be, because it seems very broad. At the same time, it could seem very narrow, depending on who's reading it and who's interpreting it. So it was great to see that this third one does impact more than what we thought initially, as we got some additional guidance in another interim rule that was published. And this rule basically went on to say that they're going to interpret guidance from those 3 federal agencies as also being state and local shutdown orders that would have been based in part on that federal guidance. So the long and short of that just means that if you're a non-essential business and you're shut down, it's all related to this same aspect of the federal agency guidance, those COVID regulations. Otherwise, it could be a lot more facts and circumstances based, whether or not you qualify for this exception to use the easy form. What was nice though is that this rule that came out also provided an example, and I put it all on here on the slide. I'm not going to read it all, but I'll give you the gist of it. The example was a beauty store that had online sales, and it had a physical store location as well. And during this time, that beauty store was subject to a state shutdown order, so they weren't able to operate their physical store because of that. They were a non-essential business. Because of that, even though they were able to continue their online operations, because they were subject to that physical store shutdown order, they're able to use the easy form. They fit these requirements of being subject to a shutdown that's related to these federal guidelines. And at the end of the day, that's really the summary, the bottom line. If you are subject to a shutdown, if you were a non-essential business and you had to close your doors in some way, shape, or form, you can use the easy form with this rule. And that's a wonderful thing. It's a lot shorter, a lot less work, and the main benefit is that you don't have to worry about your full-time equivalent calculations, and those can get complex. They can be a little bit annoying. They can be a little bit painful, and we'll get more into those. And so it's nice when we don't have to get into that level of detail by employee and all the exemptions, if we can just use the easy form. So this will certainly be a big help to many of us. Next, I want to take a couple of minutes to talk about the qualifying costs. And I think these are things we're all pretty aware of at this point, but want to review and talk about some of the nuances that we've become more aware of. Qualifying costs, of course, break down into the two main categories, payroll costs and non-payroll costs. And the interplay between the two can be important. And we get a lot of questions in this area, so I just want to run through this one more time for everyone. Non-payroll costs can't be more than 40% of the forgiven portion of the loan. So that another way of saying that here is payroll costs must be at least 60% of the forgiven portion. You got to have that ratio. But the question we get all the time is, well, can I just use payroll costs for all of it? Yes, you can do that. But you can't use non-payroll costs for everything. It's the Paycheck Protection Program, is the PPP. It was designed with this in mind in such a way that you wouldn't get those non-payroll costs forgiven if you didn't have the appropriate ratio to your payroll costs at least. So it's more a mechanism to make sure you're not just laying everybody off and then the owners are still getting to cover all their remaining costs in the meantime. So yes, you can use it all for payroll costs as well, but that 60-40 max ratio has to be applied when it comes to the non-payroll costs. So I think with the 24-week period, this is far less of an issue for most borrowers than it would have been with the 8-week period. And these percentages have also gotten a little easier from the original 75-25. So delving a little bit deeper then into payroll costs. Payroll costs are made up of the actual payroll itself, the gross pay during the covered period for employees. Bonuses are allowed in that amount. That's a very common question we get. And we'll talk about the limits on the gross pay in the next slide. When it comes to using your payroll and calculating this, I'd highly recommend using the alternative payroll covered period for simplifying your reporting. And the reason for that is just that whenever we can align our pay periods with the covered period, and that's what the alternative payroll covered period does, then we can just run weekly payroll reports as our support. We don't have to look at trying to figure out, well, this last paycheck had these many days that qualified and have to prorate it. There's just really no need for that and nothing gained, especially when we're using longer periods like this. We just want to be able to use the simplest approach possible and use that to report. So I'd highly recommend using the alternative payroll covered period, which just means your covered period for payroll costs starts on the next pay period starting date after you get your money. Although all your non-payroll costs still follow the regular covered period, the day that you got your money. Certainly something that's useful and simplifies what we're doing for payroll, using it in a way that matches our pay periods. So we get to use gross pay. We also get to use certain employee benefits. And a recent clarification here was that prepayments are not allowed. And those are for employer contributions of group health insurance, employer contributions for retirement plans, and employers' state and local taxes paid. So the prepayments not being allowed was a bit of a surprise. It didn't really make sense compared to all of the other rules that had been understood up until a week or so ago when those FAQs were published. But hopefully we're in a position with 24 weeks that we have plenty of costs and don't need to worry about getting those prepayments in there anyway. So another thing that was clarified here back on the 11th was that for our group health insurance, vision and dental are now included in that. It's not just major medical, it also includes vision and dental. There's no other clarification out there if other types of group insurance would be allowed. Retirement plans, again, can't prepay those. That had been a big thought on top of maybe an employer match every payroll. Can we get a profit sharing contribution in the covered period? And the answer at this point is, well, yes, we can still do that, but only to the extent that profit sharing is for that covered period. So an entire year's worth, we can't squeeze into 24 weeks. We can only get 24 weeks worth of that annual profit sharing amount. So again, just a little more convoluted, but hopefully we don't need to go to that level of detail. For the state and local taxes paid, this is usually our PA unemployment insurance that we're seeing here for our clients locally. Not a huge number, but something else, again, that qualifies here for our payroll cost. The caps get a little bit complicated, and so we laid out a slide here that hopefully is a good reference for you when you get to looking at especially the owner's compensation and how do we record that. For everyone that's not an owner, it's a whole lot simpler. If you have an 8-week covered period, you're capped at this $15,000 number here at the top chart. If you go all the way to the 24-week period, that number triples to $46,000. And these numbers are based on the fact that we are capped on forgiveness at $100,000 per employee when we're coming up with these caps. The caps shift a little bit here for owner employees. While it's the same at the 8-week period, at $15,000, if we go all the way up to the 24-week period, we don't get to triple that number for owner employees. We're stuck just at this $20,000 number, which works out to 2.5 months of the forgiveness amount. And the rationale there, basically, we've seen over and over again in the guidance, is that this is not intended to be a windfall to the owners. The PPP program does include owners, but is designed in such a way that those benefits won't be maximized to owners. Instead, it really should be going through to the employees. And the 2.5 month limit there at $20,000 just aligns the forgiveness calculation with the original loan application, because on the loan application it was the monthly average for 2019 times 2.5, get that 2.5 months worth to get your loan. And it's the same calculation here for owner employees to get it forgiven. So it's a limit that's based in some common sense, but hopefully doesn't hurt too many of our clients once this whole thing is done for a 24-week period. When it gets to the non-cash compensation, this much more complex chart down here at the bottom, it's very confusing. So I think this is just something to reference and come back to when you're doing your calculation, depending on how your business is structured, whether it's a Schedule C operation, a partnership, S Corp, or C Corp. You can see there's different results there based on what we're looking at, and there's not a lot of rhyme or reason if you're just looking at this chart. There's been a lot of ink spilt over this. I'm not going to spend an awful lot of time on it, other than to say when it comes to those owners' benefits, they're not part of your cap of $15,000 or $20,000. All benefits are on top of the other compensation cap, but they're severely limited, and it just depends based on how your business is structured. And just come back to this chart whenever you're looking at those owners' compensation and those owners' benefits. I should mention, though, here before I come off this slide, up in the top right here, that owners are additionally limited to 2.5 months of their 2019 compensation. So even though this compensation cap exists, of course, you're limited to what is actually paid during the covered period, but you're additionally limited for owners to what they paid themselves the prior year. So we can't have an owner that was, for whatever reason, paying themselves $50,000 in 2019 suddenly give themselves more of a raise here in 2020. The whole rules are just set up to basically maintain what had been there prior. and we can't give ourselves as owners bigger bonuses to get to that point. So that's something else that's been clarified, again, more recently. So now switching gears from our payroll to our non-payroll qualifying costs. And again, hopefully this is review here. I think we're all aware of this by now. We have interest, we have rent, and we also have utilities. Interest, most questions there is regarding which interest. And it has to be interest that's secured by a hard asset. So if you have a auto loan that's secured by the title of that vehicle, that's going to qualify. Traditional mortgage interest on a real estate that's secured by the real estate, that's going to qualify. If you have debt on a line of credit that's unsecured, that interest isn't going to work. It's not secured by any hard assets. Similarly, loans to shareholders or partners traditionally don't have any security attached to them, so that's not going to qualify either. Rent for real and personal property is a pretty straightforward one. Haven't had a lot of questions on that one. That's your traditional real estate rents or your leases on vehicles or copiers or other equipment. Those are all going to qualify. Utilities is where we have so many questions. The listed utilities in the law were electricity, gas, water, telephone, internet, and transportation. And we've only got a couple of clarifications from there. And the first was this last one, transportation. The transportation is actually the transportation of utilities. So distribution and transportation charges you might see on your electric bill or on your gas bill that are part of a state or local municipality distribution charge, those are all included. It wasn't the broader transportation argument that many might have been hoping for, that all travel costs are somehow qualified costs. So that's not going to work. Buying a vehicle or that flight to the Vegas conference or the cruise, none of that's going to work as transportation. Here, it's all transportation as it pertains to utilities transportation. So I don't think many of us were really looking to hang our hat on that one, but that was one of those areas that had many, many questions over and over, and that was finally clarified after all these months here just a couple weeks ago on these FAQs. The one thing I want to note on utilities, though, is that there was a very early example used in a published rule of gasoline used in a business vehicle being allowable. And that's about all the additional definitions and explanation we've got around utilities. So that one's out there. It doesn't really make sense as a utility. You wouldn't normally think of it, but it's in the guidance. So that one still is there in a unique way. But otherwise, all these other questions that I've heard about very specific business utilities, or even stuff that we would otherwise traditionally think of like trash as a utility is very normal, but it's not specifically listed. I just don't think you want to claim those. It's not really worth it at this stage if it's a gray area. And in the broader sense, it's a great time to say that utilities as a whole are probably worth ignoring at this stage. If you're going to be going to the entire 24-week period, you do not need to claim all your costs. And going in and trying to find all these little utility payments that aren't going to amount to much may not be worth tracking and applying for at this stage and getting all that back up, because whatever you submit in that application, you're going to have to submit those receipts, those invoices to support that documentation. You have to submit payroll. That's easy. We have to do it. It's going to happen. If we need to submit the interest or the rent, that's not usually that hard. Those are usually bigger amounts, so they're more meaningful expenses to claim. But hopefully you don't even have to get to the level of claiming utilities, because it's just a little bit of a mess, and it's probably more work than what it's worth, and hopefully you have far more costs than you need anyway. So I've already been pushing clients and having others internally at the firm think through that and say perhaps we even just apply with payroll, or at least just lob off some of these areas like utilities that might create a lot of work and paperwork but don't necessarily result in a lot of benefit. And that's just as a result now of this 24-week period has really made it a lot easier for all of us to find those costs in other places. One last point on non-payroll costs here is that all non-payroll costs must have existed prior to February 15th in order to be eligible. We can't go out and rent a new vehicle or get some new debt and be writing off that rent and that interest. This all has to be something that existed prior. When it comes to our qualifying costs, timing is also very important. So it's good to reiterate and remember what the rules are around timing. All of the amounts that we are paying have to be either paid or incurred during our covered period in order to be eligible for forgiveness. So what exactly does that mean, paid or incurred? Well, costs could have been incurred prior to your covered period, but they were paid during the cover period, and that's going to qualify. The example I like to give is the electric bill. That we have an electric bill that was for the month of March. We receive it sometime in the month of April, and we pay it in April when we get it, right? We get our PPP funding also in April, so can we claim that bill? We paid it with PPP money after we got it, but the expense was for last month, and that's okay. It's paid during the cover period. So it doesn't matter, even though it was incurred prior, we can still pay it during the covered period and it's going to qualify. And going the other way, if we have costs that occur during our covered period, but then are paid sometime after the covered period, those also can qualify as long as they're paid by the next regular billing date after the covered period occurs. So going back again to the electric bill, if we have that bill during that last month of the covered period, our covered period ends, the bill comes after the cover period and we pay it like we always do, that still qualifies, even though the cost was paid after the fact. And this was the interpretation we wanted. Early on, there was a lot of worry about paid or incurred and what would this mean as far as how we claim our costs, and it was a very loose definition, thankfully, so we can capture everything that was paid in the period, and we can capture even costs paid after as long as they were incurred during that period. So just a refresher then on the period itself. Generally, we're talking about either an 8-week period or a 24-week period now with the Flexibility Act. But it's important to note that there was additional clarification on this, and it was at a time a couple months ago, the biggest question I got, well, what if I don't want to wait to 24 weeks? If I just want to file it whenever I can file it, do I have to wait all the way? You don't have to wait the whole way. They did clarify that you can apply at any time before the end of the covered period. So this creates many options. You can file at 16, 20, 22 weeks, whatever you end up filing at. Of course, there's reasons why you still may want to wait that we talked about earlier in this presentation, but we end up with a lot of options there for the covered period. So I think I'll be continuing to advise people that just waiting for the 24 weeks to end is still going to be their best course of action for all those reasons that we've discussed. But if your bank's ready, if you're ready and you just want to get this thing done at 16, at 18 weeks, that's okay too. We just want to make sure, of course, that we get that full forgiveness, whatever the situation may be. The last point I want to make here on the timing of your costs and claiming them is that you do not need to claim all eligible costs. And this goes to points that we've already talked about. Just like utilities might not be worth bothering with and claiming, you don't have to claim them. But you might have incentive to claim other costs just so that you eliminate potential reductions that could occur. Or perhaps you just want to sleep a little bit better at night knowing that there's this nice big buffer between your loan amount and the amount of expenses you used to apply to say, well, the bank doesn't agree with me on one thing, the SBA tweaks another thing, I'm still applying with 150% or 200% or 300% of the total cost that I need. So whatever adjustments they make won't matter at the end of the day, even if I did this the best that I could and it ends up not being absolutely perfect. We still have a big cushion. We still have a big margin of error. And it's just a great strategy to appreciate how much cost you can accumulate to eliminate that concern, and also to eliminate some of these reductions that we're going to talk about now. So just a reminder, everybody, I think you're probably well aware of this too, but your forgiveness can be reduced if you don't follow the rules of the program. And the rules of the program are related to how much you're paying the employees. They don't want you to reduce their rate of pay more than 25% or else you'll get dinged. Also, we want to have this paycheck protection program mean that you're keeping your employees. So your number of full-time equivalents, if those are reduced, you're also going to get dinged proportionally compared to a look-back period. So let's just examine these one at a time, talk about them, just get a reminder for what this means and some of the clarifications. The reducing the rate of pay more than 25% caused a lot of concern initially. What would this mean? Is it a double reduction if we reduce someone's hours? But this was clarified very well. This rule only applies to salaries and wages being reduced more than 25%. It does not relate to a reduction in hours. That's going to be reflected in our full-time equivalent, our FTE calculations. So my example I always use with clients is, hey, if we're paying someone $10 an hour, and their check goes from $400 down to $100, well, we took them from 40 hours down to 10 hours. We cut their hours. We didn't cut their rate of pay. They're still making $10 an hour. You don't have to worry about this calculation in this equation. As long as you're still maintaining that rate of pay or that salary, this doesn't apply to you. Reducing hours could reduce your full-time equivalent headcount calculation. We'll still talk about that, but this is completely separate. And that was something that was a relief when that was clarified. The original law left some ambiguity, and they've made that better sense. One other thing that was clarified here just this month in the FAQs was that this is just salaries and wages. So if you have a change in the tips or the bonuses or commissions or other incentive-based compensation, that doesn't matter. All we're talking about is someone's hourly rate of pay or their normal salary when we're talking about this reduction ding that can happen if it's more than 25%. So I know there's a groan out there for all of those that owned restaurants and didn't know how this would apply and might have been paying individuals extra tips that they didn't even earn from actual work, but we needed to try to avoid this reduction, right? And now, looking back, they clarified this rule, and that wasn't the case. But each situation, we were doing the right thing at the time with the rules that we had. So it was definitely a tough one. But now, looking at how these rules have developed, there's very, very little situations I think that this is actually going to apply to, because if you're actually cutting someone's rate of pay more than 25%, from a $10 an hour employee down to the minimum wage limit, or cutting someone's salary by more than 25%, most employers probably weren't doing that and keeping that person around. I imagine it's more likely they were just laying that person off completely if that was going to be that much of a reduction. So again, I'm sure there's cases where this applies, but I imagine it's less common than the headcount issues. Lastly, just a reminder, this reduced pay only applies to employees who are earning less than $100,000 when we looked at the last year, in 2019. They're the ones protected under this rule. So if you had borrower with employees making over $100,000, they could cut their pay as much as they want, their rate of pay, their hourly wage, if they were high earners, and there's no consequences, at least as far as the PPP is concerned. The next reduction that we need to be watching out for when we're doing these loan forgiveness application is full-time equivalents. And this is probably the one thing that really, really could cause headaches and still matter, because now that we have 24-week periods and it took this long for the SBA to open up their forgiveness applications, most businesses by this time have spent the money and have overspent the money, and spending the money wasn't the problem. What may be the problem is, how did our head count go during this covered period compared to these look-back periods? So let's just remind ourselves what the full-time equivalents are based on. It is this covered period versus the look-back period. Those look-back periods are either the first 2 months of 2020, 3.5 months back in 2019, or if you're seasonal, any 12 weeks between May 1st and September 15th, if you're a seasonal employer again. So you get some options there. You can pick the period that the best looking look back period for you. And hopefully in the cover period, we were able to do pretty well. Now, if you didn't do well, there's of course the ways around this that we talked about already. But we don't want to go and go too deep into those details, really just because these FTE calculations can get very confusing quickly. And we've gotten no additional guidance on how this may work. So even our tool to manually do this and some of the other tools that we've seen out there that processors are using, don't all necessarily use the exact same formulas to do this and could have different results. But as long as you're using the same methodology between your look back period and the covered period, we're going to be in a pretty good boat. Hopefully you do work with a good payroll processor that is running some of these reports. So we've seen great things. ADP, Paychex, the big ones, and others have all really created these FTE hours reports that are going to make this process a little bit simpler. You enter your covered period dates, the look back periods are set, and you can run comparison reports for the normal methods and the simplified methods. And hopefully that's the approach that you can take here and not have to do this manually. But we do have our tool that we've updated for this. If you do your payroll internally and don't have access to those third-party reports, there are still other ways of accomplishing that, just a little more manual of a process. One thing I should mention with FTEs is that there is a restoration date, and this was particularly interesting for those businesses that might have shut down completely and didn't rehire employees until they were perhaps able to operate at some later time, perhaps until Pennsylvania got to the green phase. So that's okay, even though it might have been 0 full-time equivalents for a large portion of their covered period. As long as we can bring that full-time equivalent level back at or before the end of this year, a certain safe harbor then applies here for FTEs, so you're not going to get hit with that reduction. So something else to watch out for if you're in that situation. We should probably talk more, make sure we have that strategy buttoned up and how you'd rehire. Additionally, there's other exemptions. There's a lot of rules circulating on these FTEs. If you do run into issues with FTEs, you're going to want to come back to this slide and look at these exemptions. This is copied straight out of the instructions for what exemptions could apply, and mostly it's things that are going to be outside of the borrower's control. So if you offered to rehire your employee once you were able to reopen and they refused, that's not going to count against you for full-time equivalents. You just have to document that. The same is true for employees that you offered to restore their hours that may have been reduced. The same for those that would have been fired for cause, voluntarily resigned, or requesting a reduction in their hours voluntarily. So there's a lot of situations here where if it's outside of the borrower's control, again, we can get an exemption that's not going to ding us for this reduction, and that's very, very important. But probably more important than all of this that I've gone through with full-time equivalents is just the understanding that we need to calculate it, we need to do our best with it, but I don't think it should really be driving our decisions anymore since we have the longer covered period, just because these reductions, both of these reductions, can be cured just by applying for forgiveness with more eligible expenses than the actual loan amount itself. And this gets to be sometimes a confusing topic, so I just go into a simple example when I'm talking about this internally and with clients. So in my two scenarios here, we have the same PPP loan amount and the same FTE full-time equivalent reduction. Their head count was down 50% compared to where it was for their look-back period. In the first scenario, the borrower only applied for forgiveness with $10,000, the same amount of eligible expenses as their PPP loan. So their full-time equivalent reduction, their head count was at 50% of what it was. So their subtotal there, their forgiveness is cut in half from $10,000 down to $5,000. So that's all that's forgiven. Now the other half of that loan needs to be repaid by the borrower. So in scenario 2, it's the same loan amount, but now we're applying for forgiveness with far more eligible expenses than we need because we have a longer covered period, we have more rent, we have more payroll. Even though our head count is still only half of what it was, we're at 50% for our FTE reduction. That 50% is applied to the total eligible expenses that we applied for. That $24,000 is reduced to a subtotal of $12,000, and that's still more than what our PPP loan was. So our PPP loan is fully forgiven still, even though our head count is down 50%. And this is a simple kind of extreme example, but it just kind of proves out what I've said a few times already and is probably the most important point of applying for forgiveness. We can use a longer period, we can use far more expenses than we need, and we can cure some of these other problems that were causing so much headache earlier of, do we need to do we need to hire this person or that person, or how are our FTEs here? Can we manage them? All of those fears become a lot less worrisome when we can have a lot longer period and apply with perhaps 200 or 300% more costs than what we actually need. So certainly a valuable thing there. I think it's a loophole really in the fact that they expanded the periods and the calculation stayed the way that it was. So it's a phenomenal, very borrower friendly aspect of the way the program has developed. Briefly here, I just want to mention that we are still here to help, and I know there's been a lot of people reaching out, and I've been in contact with many, and you've been in contact with many others here at the firm that have done such great work in helping track costs, helping do calculations and estimates and projections. So continue to do that. Continue to reach out to your points of contact for help. You can continue to go to our webpage for resources, and I'll show you what that looks like here in a moment. And we're here to assist you with these forgiveness calculations, whatever they may look like in your situation with your bank. So whether we are involved in that process directly, or perhaps just reviewing as the second or third set of eyes before we get that submitted, we want to be here to give you that extra peace of mind and make sure that we're using everything that we can and every strategy available to ensure that we're safely applying for full forgiveness as we can. Before I jump out of the slides here and show you the tools on our website, I did want to mention just a few other things that are out there on the horizon as far as potential COVID relief. There has been some proposed legislation. I'm sure many of you have heard about this that would allow this deduction for PPP expenses. And we're very hopeful, but there are no guarantees at this point. We're continuing to be monitoring the situation and be looking at what strategies may be out there. But we do hope that since this was the congressional intent originally, that they will pass some correction legislation to make this work in a technical aspect as well. That's certainly huge for our clients, and we're aware of that. We have loans that are ranging from hundreds of thousands of dollars to even millions of dollars. So that kind of taxable income swing that's an unknown at this point is certainly on everyone's mind. Another large relief package has been proposed and talks are stalled. This is something else I'm sure everyone has heard about. Given the politically charged environment and the election year, it's hard to imagine how this is going to go, and no one's going to be able to predict if this is going to happen or not. But hopes are not high, at least at this stage. So if that would happen, again, much with the PPP could be simplified based on proposals that are out there. A second round of PPP could come as well, and we would be helping you through that if it did happen, and many other relief provisions that would affect different clients in different ways. So we're going to continue to monitor that. There may or may not be another major relief package here still related to COVID. Because those talks stalled, the president went ahead with an executive order here that would defer employee payroll taxes from September through the end of the year. This executive order is directing the Treasury to issue guidance on how it's going to work, and this is expected to be a voluntary program. So we'll be issuing another blast to try to describe what this is, how it'll work, if it's even a meaningful thing once we get this Treasury guidance, hopefully here in the coming week or two before we get to that September 1st start date. Lastly, on this slide, we have other state and local assistance opportunities. We've seen many, and we've been pushing this information out, through our social media, through our email blasts, locally, through counties, through state grants. There's been many, and we're seeing that there should be more on the horizon, and we'll continue to try to share that information and direct that to you the best we can. Additionally, we've seen great resources and summaries and bringing information together by local chambers of commerce have been phenomenal through this time, and really just being able to be a resource to their local businesses. So I would highly recommend, if you're not on your chamber's mailing list, if you're not a part of that and have reviewed those websites, that's absolutely a great step to take in this time. So lastly here, I want to be able to jump out of the slides, look at our tools on our website for you quickly, and review what's out there. And hopefully this is going to be a useful aspect of what we're doing here. Many of you have probably already seen and worked with our tools to date, and they're mostly the same right now. We've just done some small updates. So if you are out and going to troutcpa.com, we have our entire COVID-19 resource page. That's still up and running. If we click on that and come down to the resource page, there's a lot of great information out here. And under our stimulus package and PPP loan page, we have all of the guidance and tools related to the Paycheck Protection Program. Most importantly, I'll have links here to the official SBA forgiveness application and instructions, the easy and the full application, in addition to what we call our worksheets, which we've created both for the easy loan and for the full loan forgiveness application worksheet. And the reason that we did that was mainly just to be able to produce the exact same thing as what you're seeing on the official form, but just in a usable format that's doing some of the calculations for you that you can actually enter. Unfortunately, the PDF the SBA has isn't even a fillable one, and perhaps that's by design. But what we were able to do is just put that into Excel, make it a little more user-friendly so that you can use it if you need to. It's probably an important time to note here, before you run out and look at the application worksheet and fill all of that out, we do expect that many banks are going to have their own application portals to be able to upload information. It'll be the same underlying application as the official form, but banks are many probably not actually going to take the official form itself, as they'll have their own system, their own portals to be able to do that more automated. So before you duplicate any effort, it's definitely good to understand the process and know what your bank specifically is doing. But I'm sure there's many, particularly the smallest ones, that will just be using the SBA application itself, just similar to how we saw some bigger banks using their own portals versus smaller banks using the actual paper form when it came to the original application process. I'm sure the same will be true here on the back end. Also on the website, it's worth me pointing out here that we did get the forgiveness FAQs, the frequently asked questions, and we have a short article just explaining those changes that came out, and we covered most of them here today. Also, there's more detail on our worksheet and the application itself, which is largely not changed since May and June when it originally came out. It was only really updated for the change in the covered period, going from 8 weeks to 24 weeks. So if you want more detailed step-by-step look through our worksheet and how that flows, I would recommend going back to this earlier webinar here that's also here on our website and out there on the Trout CPA YouTube channel as well. So just jumping over to that worksheet here really quickly. Again, what we've done is create the SBA form in a usable format. All of the green cells are where we can input the information and the basic data, and everything else is going to be able to calculate. So we only have to do certain entry. Makes things an awful lot simpler, that's for sure. We just enter our non-payroll costs, we're entering our PPP loan amount. On our Schedule A, instead of filling out this whole form, most of this calculates and pulls from other forms, and all we're entering is our benefits for the employee benefits, health insurance, retirement, taxes. The Schedule A worksheet is back here as well. Again, this is where things get a lot more complicated, where we have to enter information by employee and be looking at their average full-time equivalent calculations by employee. So this is where things get most painful, and why we want to use the easy form wherever we can to just avoid using the Schedule A worksheet or the Schedule A itself at all. Otherwise, I'm not going to spend an awful lot of time going through the worksheet step by step. Again, we did that in our earlier seminar back in May and in June. But what I did want to point out was just a change here when it comes to the calculations of full-time equivalents. We have added a section here where if you are using a period that's 8 weeks, you can enter that number of weeks here, or 24 weeks, you can change that, or even a period in between. If you do file at 16 or 20, whatever that may be, you can use this to perform a manual calculation. Again, I hope you don't have to do this and go in manual. I hope you have some great payroll reports that you can pull, and that's going to be simple for you. But just in case, that's one of the few updates we have made. Otherwise, these forms really have not changed since our original seminars and our original detailed walkthrough of how these forms work. So again, this is out here and hopefully a very good and useful tool, but in many cases, I'd say before you go and do this, look at what your bank's doing, look at their portal. Don't want you to have to duplicate work, so what they have may be very similar. It may look completely different. The underlying information is still going to be the same going to the SBA, but we don't want you to have to overwork it if the bank has a very different process. Particularly if you're working with a bigger bank, I'm sure they're going to be using automated portals if you haven't already seen that. So thanks again. I like to just thank you all for taking the time to view this video. I hope it has been a good summary and takes some of the pain out of this forgiveness application process. If you have any help that you may need with your application specifically, don't hesitate to reach out and contact us. Thanks again for joining. I hope you have a great day.